going to kick off our presentation on 174 and FinCen. Today we're going to go through a quick agenda to cover key issues along 174, and we'll get right into questions to start off, keep it interesting. The quick segue, just talk a little bit about our firm and how we work, and then we'll get into kind of the meatier subject of what is Section 174, what is FinCen, and then we'll wrap up. So to get kicked off, we're going to start with the interesting fact of the day. Today is April, but as of this recording, the last available data on processed returns was as of March 1st. We had 53 million tax returns with about 36 million in refunds. It's just a fact that the IRS releases, creating some FOMO that if you haven't filed yet, you might at least want to get an idea of what you're going to owe or get refunded, because 53 million taxpayers have already filed. The average return this year is up to a little over 3,000. Doesn't mean anything for you individually, but some interesting macro data nonetheless. In terms of expectations, today we're going to talk about 174 and the Corporate Transparency Act, also referred to as FinCen, also referred to under the name of the Beneficial Owner Information, BOI, the BOI. So hear a lot about that today. Before we continue, I want to make sure that we list off the disclaimer that this is general information. There are always exceptions, and those exceptions can be you. So make sure you take this as context to take into a meeting with an advisor and not as the advice itself. Well, let's start off talking about what's going on in the news. So we first want to say that the deadline is coming up. Today is April 2nd as of this recording. April 15th is the day to pay your taxes. So oftentimes people think it's the day to file your taxes. That is true, but you can get extension to file. You don't get extension to pay. So I think a lot of times when we get extensions, we don't make a payment. That means that you're going to start collecting interest on that until you actually make the payment. And even if you get an extension and you file on October 15th and you still don't pay on October 15th, the interest is going to continue to increase. It increases on a monthly basis. So if you do need to make a payment, if you have an idea what that payment is, we usually recommend making 90% of it in order to chip away at the penalties that might incur. So failing to make a payment by April 15th not only includes interest, but depending on how big of a difference between what you actually owe and what you paid, there might be an underpayment penalty. The other news is that there is a bill in the House called the Tax Relief for American Families. It has important information on it with regards to Section 174, and also with regards to the child tax credit, as well as bonus depreciation. So I would say the child tax credit isn't necessarily a big driver. I think the biggest driver is going to be how tech companies need to capitalize their development costs, or how much bonus depreciation you can take. So it's currently at 80%. The bill, which is currently passed the House, you can see here in this tracker, allows for full bonus depreciation. So we're waiting for that. So I check this every week. I've been checking it every day lately, but just, refresher. It passes the House, then it has to pass the Senate, then it gets signed by the president or vetoed by the president. And once it's signed into law, it becomes law. So once it's passed, then Treasury gets to work to figure out how in the heck are we going to communicate to the IRS, how to do it, how do we update the forms, how do we update the rules? And the IRS says, hey, we're not updating any forms. Essentially, taxpayers, you guys are going to have to attach a statement, and it becomes a mess. So it really has been a mess, I think, since 2020, since really the COVID relief bills. Congress changes the tax rules of the current year, sometimes of the prior year, sometimes gives you money based on prior year current filings. And it's just, they're just kicking the problem down the road for us tax advisors to deal with. So thanks a lot, Congress. But as you'll hear in the next few questions and slides, we actually really do hope this bill passes, because it'll have a significant benefit for our clients. Well, I think what we wanted to do is we got questions already. I think the way that we formatted this is we allow clients to submit questions ahead of these calls. I have my colleague Lucy on the line here who's going to read me some questions from clients, and we're going to set a timer here. We are going to give this about 5 minutes of Q&A, and we'll see what we can get through. Lucy, what is question number one?
Hi, Miguel. Yeah, we got the first question. The first question is, will the tax reform bill pass?
That is a very tough question. It's a good question. I don't know. Like this is honestly the most trusted source I have right now, which is a tracker, which tells me where the bill is. So again, currently it passed the House. We understand that because it's a Democratic bill and they don't have they have a majority, but they don't have a supermajority. The Republicans don't have to bring it to the floor. So they haven't even brought it to a vote. You need 60 votes to bring a bill to the floor. I shouldn't say that. Congress has 51, and they're looking for people of the other party to bring this bill to the floor. There's some political risk, I think, for Republicans not to bring it to the floor. So I think the option is that apparently the Democrats can bring the tax relief bill to Senate, but it's embarrassing if they don't get the votes. So they're kind of playing chicken. But the first game of chicken is going to be actually funding the government. So we don't think it's going to pass before 4/15. I'm pretty certain it won't, because Congress is currently on a break, and when they come back, they're going to deal with the basically defunding of the government or funding of the government, depending on how you look at it. So they have that to deal with. So we're hoping that this gets some attention late in the year. So we're thinking August, September, once they come back from summer recess, is what a lot of the experts are saying. So really, I mean, this could be something that drags on until the October 15th deadline. So yeah, change is coming. What other questions do we have, Lucy?
Thank you, Miguel. Well, we got another question from our audience. What do I have to do by April 15?
Yeah, so we covered it in the slide before, but the requirement by April 15th is to pay your taxes. So, you know, someone might say, well, how do I know what I owe in taxes until I file my return? Well, that's where a projection comes in. So we do projections for our clients. So you don't need to file necessarily to get an extension, but you do need to pay, and how much you pay. Either look at what you paid last year and use that as a proxy, depending on if things were relatively similar, keep up with that same amount, or get a tax projection from a tax professional.
Okay, Miguel, we got the next question. What if I can make an estimated payment?
What if you can't make an estimated payment? Well, you're going to incur interest. So it's kind of the same way that you answer a question. You know, what if I can't pay the taxes I owe? But I think the first step is, you know, getting tax strategy. So can you get the tax bill down is the first question. And then the second question is, okay, once I know how much I need to pay, can I make some of the payment? Can I make an estimated payment? Or can I set up a payment plan? You do have to file your tax return in order to get a payment plan, but you know, look, the IRS just wants regular payments. They don't want you to go bankrupt based off of your tax liability, despite what some may say. They just want compliance. So you want to file, you want to get tax strategy, you want to file, and you want to set up some kind of payment plan, whether it's your plan or whether it's a structured plan with the IRS.
Okay, thank you, Miguel. We got another question. What happens if I don't comply with FinCen requirements?
So we're going to talk a little bit about FinCen. Essentially, if you don't comply with FinCen, you go to jail and you get fined $25,000. It is a criminal provision that's being broadly applied to small businesses everywhere. But basically, you do not want to not comply. There's reasons for that. It's essentially a measure to catch some of these shadow LLC, you know, kind of you know, whether they're narcos or whether they're, you know, offshore kind of bad actors. The government wants a very strong tool to hold these guys in jail until they can actually find charges. So really, you don't want to be on that list of not complying. So you have to comply with FinCen if the rules stand.
Yeah, we have to take these seriously, guys. Well,
Yeah,
we got
exactly.
another question. What is the impact for software development and tech with the latest 174 rules?
Yeah, so we're getting into the Section 174 stuff, and I can see my co-panelist Ashton has joined from the fray from his long lunch break. But 174 is something that him and I have had to deal with had to kind of talk clients off the ledge recently. Essentially, Section 174 has to deal with how your development expenses are reflected on your tax return. So instead of if you made $100 and spent $100 on development in the old world that we're used to living in, you'd have zero income. 174 rules essentially say that you have to take that $100 worth of spend and you have to amortize it. Essentially, you have to spread it out over 5 years. So instead of a $100 deduction, you now have a $20 deduction, which means you made 100, you spent 20 out of 100. You now have 80 in taxable income, which means you have a tax bill. So what it means for you, startup, is that you essentially have to pay taxes. So if you weren't already in an environment where cash is hard to come by, it's hard to raise, you're really trying to extend your burn rate, Congress has basically given you a giant middle finger by way of Section 174, which wasn't a new rule that was introduced. It basically was an old rule that we had protection from, however you want to see it, for the last, since the early 2000s. I think it slowly became more friendly, but it's something that we've had the benefit of since, I can remember as a tax professional, which is now 14 years. And basically, as part of the Tax Cuts and Jobs Act, what Congress said is, hey, let's put all these tax cuts in place, but the way we're going to pay for it is we're going to let some benefits expire. And, I think when they kind of shook hands on that deal, the thinking was like, the next Congress will make sure that doesn't happen. Well, it happened. It happened 2 years ago now, where effectively the second year, where if you are a development company, you now have to amortize your expenses. You don't get the full deduction treatment.
Perfect. Thank you, Miguel. We got another question about our business. What do you need from me to file my taxes?
Ashton, you want to give me a break on this one, or you want me to take it? What do we need to file my taxes? Is a business asking what's needed to file taxes?
Yeah, I mean, the main thing that we need is your P&L. So if you're a business, we need your books to be done. We also need to know if it's our first time working with you, we need to know how the shareholder breakdown is. What's the percentage of ownerships? That's how we would generate the K1s as well that match that. And then, your EIN letter, EIN number, as well as your operating agreement. Now, if you're a current client and we've been working with you before, we already have that information. So we just need to know if anything has changed from the prior year. But P&L has obviously changed. So we need your updated P&L and your books to be done. On the personal side, we have a checklist where it just goes through all your information, dependents, do you pay any loans? Do you pay any college tuition, et cetera? So we have a checklist that we go down through that side for business, primarily the P&L.
Perfect. Thank you, Ashton. And another question is, what happens if I don't file my taxes before April 15?
I can take this one as well. So you're going to want to file an extension, as Miguel mentioned. If you don't owe any taxes, there's not going to be any interest to accrue on not paying a tax bill. So if you don't owe any taxes, still file the extension, but you shouldn't expect any penalties or anything. If you do expect a tax bill, that's when you're going to want to get a projection by your advisor, so he or she can let you know how much you should be paying. Oftentimes it's better to overpay because it is an estimate, it's a projection. So oftentimes it's better to overpay. And then when you actually file, if the numbers do come in lower, you can get a little bit of that money back as well. But yeah, you're going to want to make an estimated payment by 4/15 and file an extension.
Okay, thank you, Ashton. And now, guys, as you are the experts, what are the best tax strategies for an e-commerce business?
Miguel, I'll let you take that one.
Honestly, I think the best tax strategy early on is to file on a cash basis. A lot of e-commerce businesses are really just reading up on cash to buy inventory. Just the nature of the beast, unless you're VC backed or you're like a subsidiary in a PE structure. But yeah, I mean, you got, every time you get cash, you go buy inventory, and you're buying it in bulk, you know, because you get better unit economics the bigger that you go, and manufacturers always want to, you know, get paid up front. So really, you know, I think from an accounting standpoint, you know, we work with a lot of CFOs and controllers. We don't do this work in house. We work with industry experts to do the accounting. You know, from the accounting standpoint, e-commerce businesses file on an accrual basis. So, you know, they're only recognizing the cost of the units sold when they sell. But from a tax perspective, I mean, usually you're zero or negative. No reason to go, you know, structure your finances on your tax return to be profitable. Well, I say no reason, but then you talk to a banker and they're like, we need to see profitability. But really, I think the best kind of first step or conversation, I would say, is what does my return look like to file on a cash basis? I think outside that, you know, I think a lot of our clients focus on creating new products and new product lines every year. That's where R&D becomes really important. And the R&D tax credit is available to businesses of all types. There needs to be some engineering or design tech or some kind of even, I think design tech is fine. There's maybe some kind of technology, but if we can qualify clients for the R&D tax credit, it's even better. Non-dilutive capital coming back to the business just based on taking advantage of tax credits.
Yeah, and it's not a sexy answer, but also just on the compliance side, monitoring your sales tax obligations. Typically the first year, depending if you don't sell too much, it's not going to be a big deal. But moving forward, once your revenue starts picking up and your volume starts picking up, I can tell you how many clients we have to go back and file back sales tax items for. Then you're going to get hit with very large bills of taxes that you owe. So it's better to, pay that monthly or pay that quarterly and just monitor that so you're not getting in trouble with a big tax bill on the sales tax side.
Okay, thank you guys. And also, I know we're going to talk about Section 174, but someone is asking, how does Section 174 benefit my business?
I don't think it benefits at all, right, Miguel? I think it just hurts the tax bill.
Doesn't benefit your business. It really is. There's been a few times I've been saddened by Congress, and I really am. I really am. I think they're saddened, not even mad. It's just a bummer that Congress is just like, hey, cash strapped new startups, F you, you're going to owe taxes. So it doesn't. So that's why the R&D tax credit's important, because if they're going to hit you with a higher, adjusted income, maximize the R&D tax credit to offset the tax that you're going to owe. There is a chance, again, that's why we're really rooting for the bill that's in the House. There's a chance that this passes, and there is a chance that they retroactively allow full expense treatment for 22 and 23. So potentially, for those of us that did it right and amortized in 2022, we're able to go back and now get a tax refund for that change. So I really do hope that Congress comes through, and I hesitated saying that because it sounds ridiculous out loud.
It's just a dumb bill. It's really dumb, to be honest.
Yeah. Well, the current bill is okay. It's just a dumb rule. Was that our last one, Lucy? I'm sorry.
Yeah, we got a last question. Yeah, we got a last question. What is the deadline to file FinCen?
I believe it's January. Right, Miguel? What's the actual date? Do you know the actual date? I know it's January.
It's December 31, actually. So I think you're thinking of the penalties kick in if you're not filed by January 1, 25. So yeah, you got till 12/31. Don't spend your Christmas on the phone with your lawyer and accountant. Get it done early. We'll talk a little bit about the case that's in the 11th District Court of Appeals right now. But we'll hold that for in a few minutes. Lucy, you're on mute. So we completed all the questions, huh?
Yeah, we are done with the question, Miguel. Thank you. Thank you, Miguel and Ashton.
Fantastic. So yeah, so the format for those listening, there's a way to submit questions for every webinar pod that we do. We will handle those first, and those oftentimes structure the information we cover in our presentation. So we're gonna if you want to connect, I'm gonna leave up the QR code for just a second. Take a quick screenshot of this. You'll know where to go, how to reach us. Essentially, take it to a form. Ashton, a human, reaches out. We're not going to put you in, on with the chat robot. We'll reach out if you want to connect. So let's just cover key dates. Are you seeing anything missing here, Ashton? Basically, the big ones are 4/15, file and pay. We've got some internal things. We're doing tax projections right now because a lot of the clients do extend because they've got K1s coming, or they're part of funds or things like that. But yeah, I'd say projections and the tax deadline. Anything else, Ashton?
Well, I mean, if you have a partnership or an S corp, those business return filing dates are 3/15. But for all individual returns, single member LLCs and C corps, that's the 4/15 deadline. So if you file an extension on this deadline, you have until October 15th. Miguel, I didn't say my birthday this time, so you should be happy. But we have until October 15th to file your return.
You did. You just did. You didn't mention your birthday.
Well, expect a good present this year.
At least in his first time, Ashton always mentions his birthday is October 15th, and he thinks that's the biggest deal of October 15th. It's not. I think we had who we are. I really don't feel like talking about who we are. If you're on this call, you know who we are. We focus on tax strategy. We work with we work with businesses of all sizes. My background, I came from PwC. I got sick of working with very big companies that have armies of lawyers and accountants and bankers. And I said, what if we try and package and bottle some of these strategies and hand them out to our friends/clients? So that's where we are now. That was six years ago to this date when I was young and beautiful, and now I'm just young. But essentially, we are a team of tax advisors that are trying to take Fortune 500 strategies and rolling them out to businesses of all sizes. These are just what we look like. I don't know. What do you usually say on this slide, Ashton?
And Carla manages our bookkeeping practice. Mike manages our tax practice. We work with business owners on both the business side as well as the personal side. If you do qualify for the R&D tax credit, that's where you'll see Miguel's name a lot. He manages that practice. He's our R&D tax credit SME. And then myself, I'm in charge of operations as well as client experience. So making sure when you get on a sales call with one of our team members, you get exactly what's promised to you, and that the service that you have, you're always satisfied from the start, the middle, the end, and the continuation of the relationship. So hopefully things don't get escalated to me too much, because if they do, it's usually not a good thing, but it's happening a lot less now, so I'm happy about.
I think if there are any clients here that want to share good news, want to escalate good news to Ashton, I think that's always welcome, right?
Oh, I would love that.
That doesn't happen though.
Well, I mean, we get the good news on our surveys, so we've been getting a lot higher ratings this year than previous, which has been nice. And then this slide, yeah, we're not going to go through everything on this at all, but we at the end of the day are a tax and accounting company. I guess the only thing missing here is that we also have specialty tax, so that's the R&D tax credit as well as cost segregation studies as well. Compliance side, make sure you're paying your estimated taxes, make sure you're filing your quarterly estimated payments, make sure you're filing your returns, make sure your bookkeeping is compliant. You get that just about anywhere, but really where we separate ourselves, at least I like to think so, is on the strategy. We no longer just file tax returns, because we were seeing our clients' tax bills for the clients that we just filed returns with versus the ones that we met with once, twice, 4 times a year. And the amount that they pay is so much less that we just don't want to do that to our clients anymore, because we know how important planning and strategy is. We know how important it is to know how much money you need to save for your tax bill. So we're always putting together projections. We're doing 360 deductions reviews on a constant basis as well. And then at the end of the year, make sure you have a year end with your advisor, because that's when you can really get creative with the tax bill, or at least know exactly what your tax bill is going to do. So maybe you make some big moves. Maybe you contribute to a retirement account. Maybe you buy that equipment that you were waiting to buy. It just depends. So really, strategy is where we really shine, and implementing those strategies. If you do qualify for the R&D tax credit, we can run that. If you do need a 1202 or a 382 analysis, we can do that as well. So I'm not going to go on this slide too much, but typically that's what I would say here.
Yeah. And if I were to brag, I'm not going to. If you look at who our clients or like partners are, now they are other CPA firms. So, if you're working with a tax firm, you're like, hey, I like them, but I'm not really getting that strategy. We'll work with them. So you plug us in, and now you have a tax team. You're like, hey, my accounting's solid. I've got a great controller, CFO. We'll work with them too. So, we're at stage now where we're really narrowing in on what we do best, which is, I think, 80% strategy, 20% compliance. And that means that we work with a team of advisors. Because I think as a small, medium-sized business today, you're not going to bring in a McKinsey, PwC to handle everything. You're going to have either a hodgepodge of advisors that don't talk to each other, or you're going to have a really solid team of independent advisors that are going to triage and, triangulate what's best for you, the client. So just a neat thing of how we work. I'll just cover this to say that, hey, most of the clients, if you're on this call and you understand our niche, you're in manufacturing, tech, e-commerce, or digital marketing, some kind of service that's online based. We tend to focus on the strategies, and we build playbooks based on those fact patterns. So we know what's going on with you in years 1 to 5 as an e-commerce company. We know what you're dealing with if you're Series A funded tech company. We kind of know how much time you have. You're not here to learn the tax code. You're here to delegate it and have it executed. And us focusing on these industries really allows us to do that. There's a few, I think, technical slides here. I'm not going to get into the R&D tax credit here. We kind of talked about it at a very high level, but essentially, if you're doing any kind of dev, this credit allows you to offset your tax liability. If you're a small company that doesn't even owe taxes yet, you can offset your payroll taxes. So even if you are negative from a taxable income standpoint, the R&D tax credit is still beneficial for you. So I want to talk a little bit about Section 174. This is for the benefit of those that really expected to kind of understand what's going on. But essentially now research expenditures from salary costs to overhead now have to be amortized. So they're saying before $100 of expenses are now divided by 5, $20 in expenses. So your taxable income is now going to be higher than what they call the book income. So book tax is something you'll hear a lot in the tax space. Your book to tax is usually slightly off. Now it's going to be way off, not to your benefit. The latest bill is set to change that. I think we talked about that a little bit. So stay tuned. Hopefully this goes away. So does it impact the R&D tax credit? They work together. I think what we are saying is at minimum, the qualified research expenses you claim on your Section 174, the QREs that you claim on the R&D tax credit at minimum need to be amortized. A full 174 analysis, which is something that the Big Four are doing, regional firms are doing, really is a more comprehensive approach at looking at rent, at looking at asset purchases, computers. So it really is kind of a broader analysis than the R&D tax credit. So you should note that they are not the same thing. So the R&D tax credit is its own code section. It just says take your R&D and get a credit. 174 has nothing to do with the R&D tax credit. Even if you don't take the R&D tax credit, 174 says from a tax perspective, you have a good tax firm, they are amortizing because it's illegal not to. So I think a lot of folks are like, oh, I'm not going to take the R&D tax credit because then I have to amortize. No. The tax credit now says that you take your research expenses and you amortize them. Even if you have a foreign offshore operation, you amortize it over 15 years. So it's even more painful. Wait and see. I think there's a lot of taxpayers taking a calculated risk and saying, I'm just going to expense it. And we'll say that. Like I've definitely seen that. Actually, we have a few clients who said, hey, I'm just going to expense it. And if Congress comes back, because we think Congress, we're hoping and rooting that Congress comes back and gives us that treatment so we don't have to change our tax returns. Well, that's not the right way to do it, because the reality is the law of the land says you need to amortize. And what if Congress doesn't come back And what if they do it going forward? So what if the agreement in the Senate is, hey, we're going to allow full deduction treatment, but not until tax year 2024. Well, now you've got to amend your prior year because we just don't know what's going to come out. So, Ash, I don't know if you have any thoughts on that or any questions about kind of the impact on 174 and what clients are doing specifically. Because I think it's one thing to talk about the rules and other things like what are practitioners actually doing? Because some are ignoring it. But what do you think? What have you heard?
Yeah, I mean, honestly, it's a conversation very worth having with your accountant to see what they recommend. You know, they know your business inside and out. Some of our clients, you know, they're just filing the normal way and they're just going to see what happens because who knows, this could all change. Others are conforming, you know, just like Miguel said. But Miguel, I actually have a question for you because, you know, we have our specific clients also that want to know what we should do. What have we been doing on this for our specific clients? What have we been recommending?
We're recommending at least taking the R&D credit and amortizing it. That's the law of the land. And, you know, I mean, our clients are 1 million in revenue to 50 million in revenue on the bigger end. So, I mean, in some cases, like I think we had one client that went from a $1 million profit, you know, owing 21% of that. So about 210,000 in profit, with amortization going to 8 million in profit. You know, so it's that jumps up the tax bill to, you know, 1.5 million. So giant tax swings, not for their benefit, but you know, they're at a size where you can't just pick and choose your rules. So, you know, if they get audited, the penalties on something that big of a swing. So I guess it depends how big you are, because if you have a tax swing over 50,000, that's where you start getting penalties. And if you knowingly file against what the rules are, there are criminal penalties. So, you know, we don't want anyone to get in that kind of trouble. I think I am sharing that, like, we've seen practitioners say, well, the rules are going to change. You know, I don't know what they know. Like, actually, I think we were telling clients this time last year that we thought the rules were going to get reversed. We were expecting Congress to do something last year. They never did anything. So that's forever ruined my faith in our legislative process. I know there's people listening that are like, my faith's been ruined for years. But for me, I thought, you know, hey, like, we can always count on good tax policy independent of party in charge. And
yeah, I remember last year they were saying, yeah, we're going to decide on this right after the 4/15 deadline. It's like, we can't just decide on it before the deadline for everyone, where we're going to have to go back and amend everyone's returns or file an extension form unnecessarily. And it still hasn't really come. So we're still in the situation. But just to clarify, Miguel, the R&D tax credit, that is a tax credit that offsets taxable income. The amortization with this, that is just on expenses and items that you deduct. So, you know, instead of taking 100% of that contractor spend to offset my taxable income, I'm taking what, 1/5 of it. And then I have to, you know, next year I'll take 2/5, or I guess it'll catch. Can you tell me about the catch up period of it?
yeah, so yeah, when you take 1/5 of the deduction, what you're essentially doing is you're deferring the expense to other years. So the following year, you know, it's not like you lose forever the other $80 that you don't get to take this year. You're going to take it over the next 4 years. So, you know, next year it starts compounding so that eventually you're basically back to neutral. But essentially next year, what happens is that 20 carries over. So if you have the same numbers, 100 and 100, then you end up with a $40 deduction because you got 20 from last year and 20 from this year. And then that following year, you're going to have 3 layers of it. So, you know, amortization, I think, sounds tricky without a visual. It's quite simple. You're essentially creating a schedule of deductions that you take over time, and then that starts stacking as that rule continues. That's part of the reason they're saying, hey, we're just going to undo it so that you don't have to carry anything forward. Because the complexity, if they undo it 2024 and beyond, is that now your 2024-25 tax return is going to have your full deduction plus the amortized amounts from the 2 prior years. So taxes start to get funky. So I think some of the thinking that I imagine is happening behind closed doors, there are smart people in Congress, I promise you. There are former tax attorneys, staffs that are tax attorneys. They're thinking, hey, why don't we just make it retroactive, have a form that gets filed on this tax return, because it's going to be too wonky to carry that forward over the next 4 years. So giant, we can't curse on it, so giant freaking mess.
So it basically sounds like, hey, let's just screw small businesses for 4 years until it's normal again in 5 years, and they can take the full deductions essentially of compounding. Makes sense.
Yeah, it makes total. It doesn't make any sense, but yeah, it really affects small businesses most. So it's tough to see. Like, this doesn't affect the Googles of the world, although technically, the rules do apply there. It's really hurting the small businesses that are cash strapped. Google has no issue getting cash. Well, here are some examples of things that are, expand beyond the R&D tax credit. So again, 174 applies to your whole P&L, not just the R&D. So there's some additional things that get picked up. I think the most drastic difference between 174 and 41 is that on the R&D tax credit, when we calculate qualifying QREs for salaries, we pick up box 1 of the W-2, which doesn't include everything. 174 includes everything on the W-2, including benefits. So again, the right way to do it is to have a full 174 analysis. What we're saying, again, not official advice, is at minimum amortize the QREs on the R&D tax credit. So there's a relationship between those, but it's not that the R&D credit imposes the rules on 174. It's that 174 imposes rules that align with R&D. So, it wouldn't make sense to amortize less than the R&D tax credit for sure. Well, good. I think, we only have a few more minutes. So Ashton, I wanted to pop into FinCen. How do we want to start? Do we want to start with what is FinCen? I can start there.
Yeah, because it's a new requirement. It's an important compliance requirement, which also sounds like it could be just taken back. But right now, this is the law of the land. So it is what we are recommending that you do. But yeah, please tell us, what is it and why is it still semi up in the air?
Yeah, so I think the big punchline is that, first is, what is the Corporate Transparency Act? Basically a rule that was passed on bipartisan basis. So, it is possible. But basically, it is a targeted tool to require disclosure of these, let's call them like shadow entities that, kind of bad actors hide behind. And essentially, it works fine for everyone that is willing to disclose that information. It doesn't work fine for those who, ultimately turns out like the owner is a criminal or something like that, or a trust in the Cayman Islands that's owned by a criminal, and so on and so forth. So essentially, it is a tool to illuminate the paper trail. And basically the thinking is, hey, small businesses are going to have no issue complying with this, because all it really does take, I think, 20 minutes total. We covered in a separate presentation how to actually file it. But, for most, it doesn't take much time. And it primarily applies to small businesses. So businesses with more than 20 employees, you don't have to fill it out. Businesses with their own standalone location. So they have their own building with their own name on it. So restaurants and franchises are taken care of. So who's left? Well, we're trying to capture these, kind of shadow LLCs, if you will, and casting the net essentially to kind of like all our entities, right? Like we have a partnership, we have a rental property with an LLC, like all of those now need to be disclosed. So it is a big lift. If you think about all the effort that's being exerted across the country by all these mom and pops that have, advisors like us, kind of businesses between the $1 and $5 million space, just have little resources, little guidance, and these are the businesses that hit. So there was a challenge in the 11th circuit. I think we just have some points here. But yeah, I think we covered before, the penalties are absolutely just ridiculous. So yeah, it's the $25,000 and time in jail. Like, you've got to file it if it's the law of the land. But there was a challenge in the 11th district that basically ruled it unconstitutional. Now, I'm not a lawyer, but from what I understand from lawyers is that it only applies to either the district. So if you're not in the 11th district, like California is the 9th, or I forget how it works, but we're in California and Texas, like, we're not excluded. And if you're not that specific business to challenge, then you're also not exempt. So no one's exempt technically from this lawsuit, but because there needs to be agreement between lower courts and higher courts, we're waiting to see, or I guess the strategy around challenging this, we understand, is that there's going to be challenges in other districts. And, essentially once that happens, it gets elevated to the Supreme Court. So it would make sense, right? Like, wouldn't it make sense for the Supreme Court to hear it like over summer or like by September, so that we don't all go through this effort and then it turns out it's not even constitutional? So we'll see. So what we're advising our clients to do, just to bring it to the practical level, actually you're probably gonna ask this, I'm sorry, is do it over summer. Let's see if there's any updates in the news, and do it in the summer. So, hey, welcome to the state of uncertainty. That's the world we live in now as small businesses, and you're understaffed, undermanned, and underadvised. So we're here together, kind of thing. But let me hand it over to you, Ashton, before I get too frustrated. Any questions, thoughts, or otherwise?
Just because there was something I read not the other day, probably months ago, when this first came out, it was saying that businesses formed just before January 1st. So in 23, 22, 21, their due date to file is December 31st. But if you're a business that was formed from this January 2024 to the present, I believe you have to file this. Is it between 30 days and 90 days of a corporation?
Yeah, that's such a good point. I'm so glad you brought that up, because I was about to leave everyone with the wrong impression. Everyone's like, oh, I don't have to file this thing.
Yeah, if you
create a new entity, you create a new entity, you got to file it within 90 days. You have to file it within 90 days. Otherwise, the penalties start occurring. So thank you. Yes, big PSA. If you create an entity in 24, you've got to file your FinCen according to the rules of the law of the land within 90 days. Other things that make you, if you change ownership within 25%, so if you sell 25% of your company, you now have to file an updated BOI. So it's called the Beneficial Ownership Information Statement. So I think there's a lot of clients that say, well, I'll just stay sole prop. Like, I was going to set up an LLC, but like, I'll just stay sole prop. I'll get commercial insurance. So, if I do get a lawsuit, depending on what your business is, right? Like how big, how much risk do you have? I mean, those are all things you want to assess with your lawyer, but somewhat on the margins, if you're between setting up a single member LLC or staying sole prop and you're selling digital marketing services, I don't know if it affects you. Again, I think like you were saying, Ashton, it's a good conversation to have. If you're going to set up a partnership, set up a general partnership. You don't need to set up an EIN, and you're not subject to FinCen requirements. What is GP? It's not an LLC. It's just an agreement between two individuals or LLCs. You get a tax ID, and there's some, talk to a lawyer about like the main distinctions, but that's a structure that is exempt from FinCen. So those are the things we're starting to see clients start to ask.
And are there any prior years that don't have to do this? Like, if we go back, because me and you have a partnership that we set up for our real estate business in 2018. So we got to file this as well, or is there any cutoff?
We got to file it as well. We are all screwed unless you have, and we have a different, maybe we link to the presentation that we did previously on like all the rules. It is like watching paint dry, guys. But yes, like, we are all in it unless you have over 20 employees, have a dedicated office. Like, you can't share that office with anybody, right? It's like, oh, okay, that's how we're excluding McDonald's if they don't have 20 employees. So, like, there are all these weird exceptions to them, but small businesses don't get out of it. you're a nonprofit, you already have a 501c3. If you're a general partnership, so it's not, you're not, you know, a explicit entity. So yeah, there's things like that that are exempt, and maybe we'll link to it, but you know, it's like we're all screwed. That's what we're gonna name this episode. Well, good. I don't know that we have any questions. I think we are open to Q&A. So if someone wants to type out a question, I think we'll stick around. But for those watching this, we're gonna wrap here unless there's a really good question that comes out. So thanks for your time, everybody. This has been a pleasure. We wish everyone a successful tax season, and just remember, you know, pay what you owe, but don't leave a tip.
Yep. Yeah, and we'll update everyone as new legislation comes out, as new, you know, the laws change or stay the same. So be on the lookout for our newsletters and any other webinars that we have as well. Thank you guys. Appreciate it.